Kevin Bupp is a Florida-based real estate investor, top Apple podcast host, and best-selling author of The Cash Flow Investor, with over $500 million in real estate transactions under his belt. Based upon his decades of experience, Kevin has identified mobile home parks and parking lots as the top real estate investments in the current market. On his podcast, Real Estate Investing for Cash Flow, he shares 20-plus years of experience guiding millions of listeners on how to find and invest profitably in commercial real estate. Under the umbrella of his private equity firm, Sunrise Capital Investors, Kevin makes investments in commercial real estate assets available to passive investors in order to help them build legacy wealth and achieve financial freedom. He also, is involved in various charities. And I got to tell you, I love people who have a clear investment thesis and follow it, and then obviously make that opportunity available to others. Kevin, I'm excited to have you on the show.
Yeah, Corey, thanks for having me, man. Excited to chat with you here today.
So listen, before we get into how you became a real estate investor and why you focus on these particular segments and what you're doing with the funds, I want to take you back to when you were a little kid growing up, maybe 8, 10, 12 years old. What did you want to be? Because I'm guessing a real estate investor and fund, and somebody put together a fund probably wasn't it back then, but you tell me.
Yeah, no, it's a great question. And I don't know if I had the answer to that question, but what I did know at a really early age, even before I was 12, was that my parents both were working parents. I mean, very much a blue collar family, but you never went without. It was all relative. Like I knew what I knew. I knew that there was other folks that lived like kind of up in the foothills where we grew up. That was like the rich area, and like we were very much in not a bad area. Like we were in a good area, but definitely not where the rich folks lived. But we also didn't have any friends that were rich. A lot of those folks went to a different school district, but you knew it was there. But again, what we had was more than enough. However, we didn't have a lot of excess. So we didn't have all the latest and greatest, BMX bikes and dirt bikes and sports equipment and all that. Again, a lot of it was secondhand. It's kind of hey, well, your older brother played baseball, so he's already got a mitt. So I think that's what you should play too, that type of thing, or you hand-me-down clothes and all that. And so I knew at an early age, I just wanted to make money. And we did that by, back then it wasn't considered child abuse if you made your kid mow lawns, Right. And so I remember riding my BMX bike up to the gas station with a 1 gallon can of gas in one hand and, one hand on the handlebar, filling up the gas, and then literally, mowing my parents' lawn. And they gave us an allowance to do so, but then we also would mow neighbors' lawns. Snow, wintertime, snow, we'd go around and knock on doors and shovel old ladies, pathways and their driveways and things like that. And so by the age of 12, I got a paper route, and again, just kind of like trying to make my own way and like buy the, back then it was material things, right? Like whatever the latest and greatest was, buy my own stuff. And so I think that the drive was always there to do something, but I didn't know what I wanted to do when I grew up. I had a drive to make money. And, ultimately at some point in time, figure out how the rich people do it. The 16-year-olds are driving nicer cars than what I did in my 10th and 11th grade year in high school and all that. So again, I just always want to make money to be able to fulfill whatever lifestyle, that I chose. And so, but again, had no idea what I wanted to do when I grew up. But I was lucky. I was 19. I was going to community college. Again, just going with no direction, attending bar in the evening, having fun doing that, making a lot of money, but just kind of going through the motions. And at that point is when I met who became my very first mentor. His name was David, and he was dating my girlfriend's mother, and he happened to be a local real estate investor. So he kind of lived in that rich part of town, and it was self-employed. And I had never met anyone that owned their own business that was self-employed, and I sure as heck didn't understand the real estate world. And he had a lot of rentals. That was his business, a buy and hold investor. Been doing it for a couple of decades, and so that was it. That was my first exposure, and so that's when to answer your original question, that's when I finally determined what I wanted to be when I grew up. And it was better understanding his business and being around him and seeing, just something that excited me, number one. And number two, a lot of his colleagues and people I met, I felt they were pretty smart, but I didn't feel like they were any smarter than I. They just knew some skill sets that I didn't yet know that I think that I could quickly adapt to and learn. So that's it. At 19 is when that happened. So that's when I finally realized what I wanted to do when I grew up.
I love it. And it's funny. It sounds like you and I've said this on the podcast. You and I grew up pretty similar. The way I always say it is that we weren't poor, but, we were low middle class, just kind of paycheck to paycheck, right?
Yep.
And fortunately, we didn't have a major health issue, or my dad didn't lose his job, or which could have sent us, So, we always had food on the table, the lights stayed on, we had a decent life, but yeah, there was never we didn't go on vacations, we didn't eat out, we didn't have money for that, so it sounds like it was a very similar upbringing. One other question looking back, what was your first deal of any type? Could have been early in that real estate career, or maybe something as a kid, anything that you remember as an early deal.
Yeah, so at 15, you can be I think 6 months before your 16th birthday, you can get a learner's permit. At least I think it's changed now, but like, basically to start driving and all that. And I happened to meet a guy. I really like cars. I like, motorized things. My dad growing up, we always had, like little dirt bikes and things like that. And my dad was always into cars. Like in the bathroom was all like the recent issue of like Motor Trend magazine. I don't know, just things like that. And so I was always intrigued by vehicles as my dad was. And so when I was 15 and a half, I had saved up money, with paper out and other means of, shoveling snow, things like that, and bought my first car. And through one of my dad's friends of friends, I met a guy before I bought that first car. I met a guy that actually owned, a mechanic shop, but he happened to have like I don't know the nuances behind it, but he had a dealer's license because every once in a while he would fix up a car and sell it on his lot, right? But he wasn't like a car dealer per se, but he had the license to sell cars, but also what that license allowed him to do was to go to the auctions, go to the car, the auctions that only licensed dealers could attend. And so he said, hey, whenever that time comes to buy a car, you just pay me $200. You come with me to the auction. You get to go mosey around, and then I'll bid on it for you. And then like I just, I make my $200. You buy a car that you like, so on and so forth. And so I did that. And on that first car, I sold it before I even turned 16. I made, like $1,500 by reselling because I realized I didn't want it. I didn't like that style. I wanted that like a sports car more than that when I first bought. And I started doing that. So like literally I started flipping cars, like literally from the age of, call it 15 and a half to probably 19, I probably had 14 or 15 different cars. I never kept track of it. I would literally trade out multiple a year and I would just keep stacking, flipping cars. I'd drive for a little bit, have fun with it, and then make $1,500, $2,000 and roll it into the next one. And so I would say those were my first like real deals. That's when I really got kind of the bug of like buying low, selling high. Just like a simple premise of just buying at the right price, buying at a wholesale price, and then selling to an end retail buyer. Like that's the first time that really clicked for me. And that's why I met David. I'm like, he started talking to me about how his formula was of how he went and bought houses at discounts and why the motivations behind it and how he made money, on the buy side. And it just, this makes a lot of sense. This is so similar. So that was it.
It's so interesting to me because there's some people, and like I've got a buddy and client and, friend, a fellow we met through our organization, and he's got, he's sold them since, but, he had a couple of core businesses that were his main thing. But this guy on the side just had, whether it was cars, like I'm talking about as an adult, right? And he would buy these cars that were, like less popular, whatever. And every car he bought, and he also liked tinkering and fixing stuff on his own. Yeah. So, so he'd buy these cars, he'd play with them a little bit, he'd drive them for 2 years and then sell them for more money than he made. Watches, he would do it with watches. When he sold his main business, he had a passion on the side for high-end audio, stereo audio equipment, again, stuff that's like, used that's for real audiophiles, right? Mm-hmm. And next thing he's got a business, he's making all kinds of money out of this hobby because he just understands how to buy this, this audio stuff, and then maybe tune it up, fix up a little bit, and then resell it for significantly more money. And I'm not talking about obviously you're talking about as a kid, but this guy's making hundreds of thousands of dollars on these side hustles. He just has that ability in different areas to see value in something and know how to buy and know how to sell it for more. It's fascinating.
I think that's the true definition of a deal junkie right there. And I think I fall into that camp. And it's funny, my wife and I still do it to this day. I mean, whether it be boats now or again, even vehicle, anything, real estate. It's funny. My wife, I'll come home with something, whatever it might be. Maybe it's a boat or whatever. She's like, let me guess, you got a deal on it? And I'm like, it's there's like a little bit of sarcasm when she says that, because It's always like, did we really need that? Or why'd you you just bought that, the same thing 6 months ago? I'm like, I got a great deal. I mean, like literally, I know that we can enjoy it for a little bit and then turn around and sell for a profit. So I don't know, my brain just works that way. And I get, obviously there's some type of dopamine rush I get from finding good opportunity and actually be able to see the value in it and extracting that value on the flip side. So, and the same thing applies to real estate, which is why it became a really good fit for me. And it's still to this day, I'm still a deal junkie. Now the deal structure is a little bit more complex than just, buying a car at an auction and flipping it to a retail buyer. But I've always been a deal junkie. I still get as much of a rush from it today of structuring a great deal, one that's going to give our, us and our investors a great return on their money. I still get that same rush today. So it hasn't gone away.
Well, listen, I definitely want to jump into the real estate side, but one last thing before we go there, because you mentioned something, you said, I think it's just the way my brain works, right? And one of the things I talk about a lot on this podcast is mindset. And, what is the mindset of a deal maker, right? And people have talked a lot about being an entrepreneur, versus being an employee. And what's the mindset of an entrepreneur? And are entrepreneurs born or made, or can, there's situational entrepreneurs. There's a whole body of work, even study, discussions around, what makes an entrepreneur and, natural entrepreneurs, situational entrepreneurs. There's a lot less of that kind of study or even stuff online or whatever. I did a whole talk in Singapore at the EO Entrepreneurs Organization Global Leadership Conference because I run the deals group there. Mm-hmm. And, I brought up this whole conversation about that, but there's a lot less around like, what is that like deal maker mindset, which is different than an entrepreneur. I mean, you can be an entrepreneur and grow an organic, and grow your company organically, very successful without ever doing a deal. So do you have any insights? Like, do you feel it is innate and natural? Can it be learned? What is that deal maker mindset?
Yeah, that's, again, I think I've always had, I don't know if it can be learned. I think if, following basic formulas, like there's certain, inherent formulas. I have this mental formula, like back the napkin, like I can very quickly identify what I feel is a good deal and not. I think you could probably teach the basic premise of that if you can really, narrow down to a real formula. But I think there's plenty of times where deals are outside the box. They wouldn't fit that formula. And so I'm not saying it can't be learned. I think it's always come natural to me. And again, I think a big part of it is there's a true, again, I haven't dug really deep into the studies of it, but there's definitely a certain rush I get, probably very similar to that of maybe, someone that with drugs. I don't know. It's just for me, I get super excited when I find an opportunity, especially if I've scoured and uncovered something that no one else has yet seen. It's not like on market. Maybe other folks have looked at, they passed, but I dug a little deeper and I saw maybe uncover a couple more rocks than the others and found an opportunity where others felt one didn't really exist or they weren't even looking at all. So, but yeah, I haven't dug any deeper than that. It's kind of who I am. And again, I think to a certain degree, some of it can be learned. I'm not sure about all or not, but.
Yeah. No, I love it. All right. So I want to take us, obviously, in your bio, we, got a little taste of what you're doing now in terms of the focus on mobile home parks and parking lots, and in terms of the fact that you have a private equity firm and a fund. But where we left off in your story was I found this mentor. You said, "Oh, wait, this is what I want to do." Sort of fit your taste with the things you've done. But you also said that he was in multi. I don't know, it was multi, but it was
single family and then
single family buy and hold, right? Which is obviously a very different business from what you're in. So did you start on the single family buy and hold side? Like talk about your evolution. Let's work our way up to where you are.
So what ultimately occurs, I knew David for a couple of months just by visiting my girlfriend. She still lived at home. We were 19 years old. And he'd be over there visiting her mom. And I just got to know him. He's a really nice guy, a really outgoing individual, and just got talking with him about, it's always intrigued meeting new people, generally speaking. I had never known a business owner. So to me, it was just intriguing learning what he did. In fact, the weird thing to me was that he was always around during like daytime hours when, me, adults should be at work, right? 9 to 5, right? Should be at their job. So that was always intriguing to me. But after a couple months of knowing him, he invited me to a real estate conference out of Philadelphia. His business partner couldn't attend. It was a 3-day conference. Basically, he was always like, just a continual learner, always trying to learn the latest and greatest and just keep up with the latest trends. And so I was like, man, he's invited me to this. He had spent $3,500 on this 3-day event. And I accepted the offer. I'm like, I don't know what I'm getting myself into. I still don't fully understand his business. I understand the basic premise of it. He buys rentals. He's got, fixed monthly expenses. He rents them for more than that, and he makes cash flow. And the last thing that really intrigued me was that his tenant, he always used to say, my tenants pay off my mortgage for me, right? And so that was always intriguing to me. And so I went to this conference, and I came back from the conference overly excited. Met a lot of people there that, again, I felt were not much smarter than I, but just knew a little bit more than I did. And they were doing, in my eyes, huge deals, right? Most of it was, fixing and flipping or wholesaling. That was kind of their business model. But like they're talking about 10 and 15 and $20,000 checks. And I'm like, whoa. And they're doing like 30, 40 of these things a year. And again, I wasn't just blown away by these folks. They took them 20 years to learn this, right? Like a lot of them were like, I just started this 2 years ago. And again, that was like, they can do it, I can do it. So I came back excited, knowing that if I didn't, continue with this excitement, actually put it to use in some form or fashion, it would just dissipate and I would go back to the normal, tending bar and going to school and not having direction. So I made David an offer he couldn't really refuse. I identified some weaknesses in his business. He was a solopreneur and he was really challenged with technology. He was about 25 years old. And I watched him struggle putting together a very simple PowerPoint presentation one day for one of his private lenders. And it literally took him like 4 hours of what should have taken him like 25 minutes. Like it was the most basic, templated thing. And so I basically said, hey, what if I help you with your business, whether it be, technology or, a helper, I don't know, dropping off supplies. He was a solo guy, dropping off supplies to your contractors, dropping off leases, whatever you need me to do, let me do it so I can just be around you and hear you talk to, whether it be home sellers, home buyers, realtors, contractors, you name it, right? I want to hear how you do what you do and what your day looks like. Just so I understand the business. And so he accepted, and I did that for like 14 months. And so I would go to school at night, or I'd go to school during the day 3 days a week I just had 12 credits a week. And then 10 bar, typically like 3 or 4 nights in the evening, and that shift didn't start till, normally 6 or 7 at night. And in between times, I would go literally be with him at his home office, in the field, wherever he needed me to be. And for over a year of doing that, I learned a ton. I got to know his contacts. I got to meet his private lenders. I got to listen to him have, hundreds of conversations, and just mentally documented everything of what he was doing, the basics of it. And I bought that first property then at the age of 20, leveraging some bartending money I had saved up, and then also one of his private lender relationships. That was the first deal. But what I really quickly realized that while he had been doing his business kind of buy and hold for multiple decades, I learned very quickly that buying and holding that first property, which I did temporarily, that, $250 a month of cash flow, it's going to be a couple of years so I can cash out, refinance. I'm not going to be able to buy that next property for many, many years, right? Like, while I'm tending bar. So I didn't try to reinvent his wheel, but I realized I had to. And so I just morphed it into a, wholesale 2 or 3 homes, keep one. Wholesale 2 or 3, keep one, until I established a lot more relationships with private lenders, OPM, other people's money, and then I was able to leverage track record after I'd been doing it for a couple of years. And then basically, for the first 6 or so years of me buying, I was able to acquire about 120 single family homes. So I scaled pretty quickly. And part of the reason was not necessarily, it was David's mentorship, but I met another guy along the way he owned 700 plus single family homes, like a night and day scale difference to that of David's business. It was just David's business, but on steroids. And I got to learn quite a bit from him and how he structured things, how he built out his teams. And so again, I own, to the original question, I own single family homes as the primary foundation of kind of my real estate career, only because I didn't want to reinvent the wheel. I kind of like, hey, it's working for them. Let's just model the same thing. And then that morphed into buying smaller multifamily apartment buildings. And then 2008 happened. It was a big struggle. That could be a whole show in and of itself. Lost everything. Sure. Started over in 2011, and that's when mobile home parks came on my radar. That's still what we're buying today, along with parking as well. So it's 2+ decades, but there was about a 3.5 year span there where it was more damage control, dealing from 08 to 11 of just trying to unbury myself and dig back out and try to figure out how I'm going to rebuild what I had already built and then ultimately lost. And then try to do it again, but in a more sustainable manner and just a better business plan overall. So,
yeah, I mean, a lot of us learn that, for me, I'm obviously, much more on the corporate deal side, but there was no M&A, there was no corporate deals, there was no financing. Everybody knows the story. So trust me, I had an interesting journey during that time as well, as many of us did. All right, I want to jump in. So one question on the second mentor, right? So now, you have this first mentor who has built this successful thing, but now the second mentor is done it on steroids, like you said, at scale. Yeah. What's the single biggest lesson, or if there's 2, 1 or 2 lessons that you got? Obviously doing something at scale like that is a whole different ballgame, right? There are some people who could very successfully do it in a more boutique way, but there's different skills, different team, different systems, all that kind of stuff that it takes to scale. What's a lesson or 2 that you got from that second mentor?
Yeah, I think there's really 2 big ones that stuck out. Is number one, identifying folks that are smarter than you in different areas of the business, and being self-aware enough to realize where you suck and where you shouldn't be, and then where you really shine and where you should be spending the majority of your time, and then not, find someone that's smarter to go in those other areas. And then the second phase of that is it's delegation. Finding the right people that are fit for that role, and then being a really good delegator, actually giving them a clear scope of work and responsibilities associated with that position, and then empowering them to do it, to actually let them run with their expertise and help you grow the business. So that, it was David was not that. I was the guy that helped David, right? Other than that, Dave was like, I can do it better. He was that. Again, nothing wrong with that business model. He did well, right? Sure. There's nothing, you can't compare the 2 because they had 2 different visions and 2 different end goals and 2 different, just where they wanted to take their business. David, he didn't necessarily love dealing with people at all. He's like, he had the mentality of, I can do it better myself. Outside of doing the rehabs, he wouldn't be in there swinging hammers. But outside of that, he didn't really want to deal with having an admin assistant or anyone else of that nature to be a part of his business. He just felt as though I'm better suited to just do it myself. I don't want to deal with personalities. And so that's why I was excited when he, kind of accepted the offer. And I think in his eyes, it was I'm bringing this friend on board. I enjoy his company. And I think I can help him by him helping me. And I think it was like a mutually beneficial thing. He didn't view it as like, I got an employee now. He didn't pay me. I did it for free anyway. So, but that was the big difference. Like, identifying, kind of your weaknesses and all, as well as your strong sets, and then hiring people to actually, do the part that you're weak at and do it way better than you would ever do it. Even if you had 99% of your time focused on it, you would never be good at it. Right. So that was it. Like, those were like, outside of that, there's a litany of other things. Like, those were the two primary factors.
I love it. I mean, that last thing you said, my listeners know well. It's what I call highest and best use. I talk about it all the time. We should be in our highest, best use areas. That we got to be, we got to be great at it. We got to love it, and it's got to be how to leverage, move the needle. You need that. That's really, some people miss a piece of that. Like, you need all three of those, and if you're able to focus your time on that, which obviously means you need to build team, you need to delegate, you need to hire people smarter than you to do everything else. So this is a conversation I've had on the podcast a lot. All right. So now we get post 2011, you've been knocked down like many of us were during the Great Recession, the global financial crisis. And you said something that's interesting, like you said something about a more sustainable business plan, right? So tell me, as you started looking at and identifying mobile home parks and parking lots as, the new business model that you're going to pursue post the Great Recession, what was it that had you say this is a more sustainable business model? What are the differences in that business model versus what you were doing before?
Yeah. And so what I did is it took me about 3 years to really get into a zone of self-reflection of like looking back and trying to figure out like, what would I have done differently? What did I do wrong? This, that, and the other. And I guess one of the big things I identified is that, and it's a little different today. There's a lot of new technology that help create efficiencies, but like that single family model, like I had single family homes spread amongst like 6 different counties. So I had maintenance guys going from one place to the next. They might only get to 2 homes in a day. Sales and leasing agents that were out in the field that were literally, driving all day long to like show homes. Just very inefficient, to where there's a lot of technology, a lot of applications that exist that didn't exist back then to help better manage those scattered type of portfolios. And so just, again, looking at the overhead associated with the property management side of the business, it was an absolute suck. And so while it might have cash flowed in the really good times, as soon as there was a blip in the economic radar and we had some vacancy issues, it became a real challenge. And so, but at the same time, reflecting on some of those small, I had a number of like 12 and 24 unit, the biggest one being a 72 unit multifamily property. Again, they all struggled during the downturn. Florida was just hit so hard. People moved out of the state. There wasn't, we weren't folks moving here. There was no jobs for a period of time. But I realized that we saved a ton. I mean, the differences of cost of like the management side of things was a 90-day difference between the single family stuff and that of the apartments. While the apartments struggled just the same, they didn't struggle with like, if we had ACs go out or we use the same exact paint in every single one of the units, one roof over 12 or 24 units. There was just efficiencies there that there was no way for us to get in the single family stuff. So fast forward, I went to a exploration journey in like mid 2011, trying to figure out this new landscape. The world had changed, especially the financial world had changed. Real estate was very different then than what it had been, pre-GFC. And so I just went out and talked to as many people as possible, finding out what's working for them, those that are investing in apartments or other commercial real estate, like what's doing well, what's not. And I really landed on, multifamily after having a lot of these conversations. Multifamily, I felt as though it was going to be the way to kind of rebuild and rescale in a much more efficient manner. And along that journey, I met this guy, Randy, that happened to be a commercial banker for 30 years. He had retired just a couple years prior, and he ended up buying 3 mobile home parks here in Florida as his retirement. And the reason being is that he said, I was on the wrong side of the P&L for the last 2 decades. I did financing for a lot of my clients that were manufactured housing developers and owners. And I got to see, their business model play out time and time again, acquisitions, cash out refinances, sales, and they did really well. And so that really pushed him to go into this asset class that was not, readily understood on a wide scale. It was kind of one of those under the radar industries, no longer today. But back then it was like, if you knew, you knew. And if you didn't, you didn't. Like that was it. It was like this good old boy club. And those that were in it did quite well. And there wasn't a lot of competition. And so anyway, I met Randy for a 2-hour lunch one day as I was going through this exploration phase. And he intrigued me enough during that 2 hours together that I left that meeting. I'm like, okay, well, apartments on hold. Let's go find one of these mobile home parks and buy one. And then either prove or disprove all the things that Randy stated. And so I did that. It took me about a year to buy the first one. I bought it up in Atlanta. major REO because everything was stressed back then. Even the best asset classes had distress to them.
Yeah.
And bought that back in early 2012 and then turned it around in 8 months, did it again, just really kept proving the concept. And I realized that this is the model, this is the vehicle that will allow me to rebuild a much more efficient and sustainable real estate investment business. And on top of that, it didn't have as much competition back then. And so they weren't readily available per se, but like the opportunity was real. I saw it. I'm like, this is such a different world. I never hear anyone talk about it. It's a very fragmented industry, lots of mom and pops. And so I just saw the opportunity there and decided to start buying them. And, fast forward, that was 2012, 12 years later, we're still buying them. And different world today. Institutional capital is here, lots of private equity in the space. It didn't exist at all. There was 3 publicly traded companies back then. It was Sun Communities, Equity Lifestyle Communities, and then UMH. Today, there's a number more. And then also there was no institutional capital in the space back then. Lots of lenders didn't understand the space. It was really hard to get debt on these things. But today, it's literally a 180 difference. Now, everyone wants to deploy capital in the space. And unfortunately, there's not enough supply to do so.
Yeah. So how are you dealing with that now? Obviously, it's when you're in early on an underappreciated asset class, right? Nothing's easy, but at least, it's easier, right? And then, it's a natural evolution of some of these spaces. People see, the early folks are successful, and then you get way more competition. Margins usually come down. So, how is the market now and how are you dealing with it?
Yeah. So it's definitely gotten consolidated over the last decade, but it's still quite fragmented. So I think the consolidation phase still has probably another decade or two to go before all the larger institutionalized properties truly are owned by, 90% of them are owned by institutional groups. Basically where multifamily is today to where it was maybe in the 80s, completely literally the same thing. That space got consolidated over the last 3 or 4 decades. And so I think there's still opportunity. Even then, I think the institutional money coming in, it's got pros and cons. Number one, we've got more competition on deals, but however, they need to deploy big checks, really big checks. And the average deal size in our space is much smaller than that of a typical multifamily transaction. The average deal size, I'd say, kind of mid-range where we play is somewhere in the 10 to 25 million range. And, number one, they want to deploy bigger equity checks than what a deal like that would need. And so they need to be able to buy portfolios. And number two, they don't want to do the heavy lifting. They want to stabilize either property or portfolio. And so there's still a lot of crappy operators out there. Even if it's not mom and pop still, there's still a lot of folks that got into the space that didn't understand the dynamics of it. It's not a set and forget it. It's truly a hands-on model. Even if it's a nicer property, it's not, hey, they're going to pay their rental time every month, but they're not going to move their homes. I mean, there's more to it than that. And so I still think there's a good run here of at least a decade, maybe more, to kind of get in, consolidate. But then I think there's even a clear exit on the back end for those that actually are able to assemble portfolios, benefit from cap rate compression that exists with a larger scale portfolio, exit out to one of the institutional groups that they're looking to deploy, $250 million at a time. They don't want to play around with $20 million checks or $30 million checks. They want minimum, if you're not showing me something where I can deploy $100 million all in one fell swoop, and then an actual, some type of programmatic, plan that we can, deploy another couple $100 million over the next, 1 or 2 years, then I'm not interested. And so I think the opportunity is still there to consolidate a portfolio. And again, if that's the plan as far as exit, I think there's a really good opportunity for folks to get in and still do that, 3, 5, 7, 10 years from now.
Got it. Great. And at what point did you decide to do the fund? I'm assuming am I right in assuming that you didn't have the fund from day one? You were doing, individual deals, whatever, right? And funding those in various ways. So
we did individual deals up until 2016. Mostly just friends, family, close associates, folks that we'd worked with historically, our own capital, and it just got to the point where we realized, again, going back to the deal junkie thing, we realized that I saw our pipeline was full, and I was almost turning away opportunities because I was like, God, the logistics associated with doing all these individual deals. I was like, number one, the legal costs associated with doing individual, capital raises on these. And back then it was like $2 to $5 million deals, right? It's just lots of moving parts to do 5 or 6 of them at one time or over a span of, call it 30 days. And so I said, look, hey, let's put it out there that we have enough for a track record to go off of with these individual deals to where we can at least speak to what we've done, the track record and the returns that we've been able to provide our investors on these individual deals, but show it on a more collective fund model. And I was always told doing a fund is it's very difficult to raise capital. It's blind, it's a blind pool fund. You might have a few seed properties that are identified, but outside of that, it's more trust, right? Let's build upon track record. And we're like, what the heck? All folks can say is, no, I'm not interested. And then we'll go back to the regular model. But we launched the first fund in 2016. and filled it up quite fast. Only ended up buying 6 properties in that fund, only because we kind of kept it short lived, like, hey, let's give it a year of like, get out there actively raising capital. And then we learned a lot along the way, learned about different structures, maybe things we should have done and should have done differently inside the fund structure. But we did the first one and went great. And then ultimately just followed it up with the second, third. Now we just recently lost our fourth one, October of last year. And I just found that our investors really like the diversity of it. But also they're investing on track record now at this point in time. I mean, we're selling the deals inside it. Like, we're giving a lot of specifics on every deal that we're putting into the fund, but it's at our discretion. And but they understand our deal parameters. Like, every single deal we do looks very similar to the last one, right? The economics, the returns, and just the profile of the deal. It's evolved a little bit over time. Like, deals are a little larger now, typically speaking, but again, the trust is there, and now we've got 700 plus investors that are inside of our inside the various deals that we have, and it's going great. Now I can't imagine going back to doing a deal specific model. Just again, from a pure logistics of like capital raising, even the flexibility. Some of the deals that we've done, without having readily available cash able to deploy right then and there, and not having to like ramp things up and try to raise it in a short period of time. Like, we've been able to take down deals all cash while working on the financing and then putting the financing on after the fact. You can't do that on a deal specific model. I mean, unless you've got just accessible cash, a lot of it available to take on that model. But even then, a little more complex. You don't have another deal come behind it where you can redeploy that additional capital into, right? And so it's definitely proven well for how we do things, and I think our investors have appreciated it as well.
Now, listen, I personally get it in that I did some SPV deals in real estate actually on my own, and then there were a couple of like great opportunities I lost out on because I couldn't raise the capital fast enough. Yeah. And we actually put together, I'm talking about on a much smaller scale, a couple of funds back in the day, but unfortunately, we raised most of that money in 2007.
Good timing.
So we had, we did a couple of small condo conversions in New Jersey. They went really well, and we're like, great. We bought some multis that were really good buys. Like, we bought smart on that. But, it was the typical thing. Once we hit the financial crisis, we actually came to our investors, and we were much less established. Like, it was a partner and I who had other businesses. I was a lawyer. He was, like, we had no track record on this stuff, right? And so it was mainly friends and family. So, in context of theirs. And we went back to all those investors because the same buildings that we did buy really well, obviously we were coming into a horrible time, were now even further discounted. And we were like, now's the time to double and triple down, guys. Like, but, and it would have been a huge thing of it. But of course, everybody was running scared in the typical situation, and nobody was, putting up another dollar. And we struggled. I mean, I felt good that we actually didn't lose. I mean, a lot of people lost all their money. We fought, scrounged and whatever, and got people back, not all their money, but a bigger chunk. Like, by the time we got them their money back, they were actually thrilled because they assumed it was all gone. So like, one fund, we got them almost 80%, another one, we got like 60% back, which is not a great result, but considering the times and whatever, they were actually pretty thankful for it.
Yeah, I bet.
But the more of a point was that, I got the model of, wait a second, it was really the trigger was, I can't act fast enough on what I know is like this, like, we lost out. There's still one deal there's one deal on that. And then there's another deal on a commercial side that I didn't get, mainly because I was the lawyer on it for a client who kept trying to hang on to the deal and extending it. And I had negotiated a billboard lease on top of this building on the west side of Manhattan that covered the carrying cost on the entire building. And it was an area that Columbia was buying, whatever. You could have just got the billboard money, cover it, and sit there and wait for the property to appreciate. But I couldn't step in on the deal because it was a client's deal. And by the time they couldn't make it happen, they had found the seller. So the one deal on the residential side that had me launch the fund, and then that commercial deal, like, I don't look back much or whatever, but if I had any deals that haunted me, like, that I didn't do, those were the two.
Yeah, no, absolutely. I know. Yeah. I mean, just the flexibility of having the capital available, it's definitely, it's very powerful. I mean, there's been what I've learned is that, on the seller side, and this even is on an institutional level, it's not necessarily it's never about the highest offer. It's always about the surety of closing. Now, surely if there's too much of a delta between where they need to be and ultimately where your offer is, even if you can close cash, there's a decision they have to make. And typically, like, they're what, somewhere in the middle, right? It doesn't have to be the highest offer, but the surety of closing, and be able to say, hey, there's no contingencies. We're not getting debt, not at least during this initial phase. We'll put debt on thereafter. It won't be your problem. Like, that definitely gets deals done, even if you're not the highest bidder, even if you're far from it. We won a deal last year that we were $4 million away. It was a $28 million deal, and we were $4 million about $3.8 million lower than that of two of the other offers, but we were closing it cash, and they are up against a debt maturity. And so like time wasn't necessarily on their side. These other groups had a track record. But they were putting debt in place. And so the debt markets were a little wonky, right? And they're like, okay, well, we just need this thing done. Let's take the money and run. And it worked out well for all parties, I think. I mean, it worked out well for us, but.
Right. So you said, is it Fund 4 that you're on now?
Correct, yes.
Okay. And is that closed, or are you still raising capital in that?
We're still raising capital. Yeah, we launched it October of last year. We've closed the third deal yesterday, and it closed a very large one at the end of last year, another one beginning of this year, one yesterday. And then we've got about $60 million of pipeline, which is mostly made up of manufactured housing, but we also have a really nice institutional quality garage as well that's in that current pipeline. So it's a $100 million fund. So once we deploy either that, or it's a two-year close-ended fund. So once we either deploy it or get to the end of basically whatever October of next year is, one or the other comes first, we'll wrap it up and we'll launch Fund 5. So
Fund 5. So talk to me a little bit about who are the types of investors, because we have, in terms of listeners of this podcast, I mean, we're not specifically a real estate podcast, we're a deals podcast in general.
Yep.
But even the folks who aren't, real estate investors as their prime business, definitely, like, a lot of entrepreneurs I know who do other kinds of deals around other kind of business, they're looking to diversify, they're looking for passive real estate investments, they're interested in this kind of stuff. So talk to me, what's the criteria of who are your investors?
Well, I mean, they have to be accredited, so they have to fit the definition by the SEC. But outside of that, I mean, they're high net worth, either high income W-2 earners or business owners that are really good at what they do and they make a lot of money doing it and need, whether it be, appreciation, or they're looking for passive income. But most of the time it's both. And then on top of that, they don't necessarily have the time or the inclination to actually go out and do it themselves. They don't have they're already busy enough with what they do. They're just looking for someone else to basically partner up with and help deploy their capital and put it to work. So, I mean, that literally is, in a nutshell, like that is, in fact, even a lot of we've got a number, I don't know the exact, percentage of our investor base that either were or maybe currently are like active investors, like real estate investors, are out there doing deals, and either came to the realization that like, it's just like way too much. It's just too much work, too much effort. I made money doing it, but like, there's only so much time in the day. I'd rather just kind of hand off to groups that like, this is all they do, and let them provide me a quarterly distribution, time in or day in, day out, quarter in, quarter out. And a number of our folks have actually sold out over the last couple of years out of their portfolio and just redeployed that capital with us, and then let us do it, to where they're passive in it and no involvement whatsoever. Just give me my, what we call mailbox money on a quarterly basis. So, but yeah, just high net worth folks that, again, don't have the time or interest to do it themselves, but they want diversity. They want to put their capital to work, and they want to, put it amongst, whether it be a diverse asset class or different industries, whether it be real estate or other types of businesses like other folks you've had on the show are involved in. So, but that's it.
Love it. And what's at the very high level, are you like a typical 2 and 20, fund structure, or like at a high level to the extent you want?
So it's keeping it simple. It's a 70-30. And then we've got 3 different classes, 8, 9, and 10 pref, depending on how much, equity is contributed to the deal or to the fund. So like an 8, 100,000 to 249,000 is an 8 pref, 250 to 499 is a 9 pref, and then anything above that's a 10 pref. And then we do offer whenever we've got, because we're somewhat different than that of maybe like a more institutional fund where they literally raise 100% of all the money. Like they've got all the money's there ready to roll. We kind of have like a rolling raise as we're doing deals. And then we hit the gas quite a bit when we've got big deals that are coming in. And so it's more of like a roller coaster flow of the capital coming in. So we will, every once in a while, like right now, we've got a pretty big deal that needs about $20 million of equity, to where we'll put out some additional beneficial terms to existing investors. We'll do a sidecar deal, even if someone's going to bring a big check for $5 million or $10 million. So we'll make very preferential terms for those that are willing to come in and put a substantial amount into the deal. In addition, maybe what they've already put in, or it could just be even a brand new investor that's looking to write a very, very big check.
Got it. So let's talk quickly. I mean, we're coming to time, and I want to hear a little, have you talk a little bit more about your book and podcast before we close out. And I ask you my final question, but just a little bit. I mean, obviously, I think there's a very clear interest indication that interest rates are about to come down.
I hope so.
That's going to cut.
He's pretty much promised it at this point, but we'll see.
Yeah. I mean, unless the world blows up in the next couple of weeks, I think we're getting interest rate. I mean, whether that's going to be, I'm not a predictor, but I gotta believe with the clear indication they're going to do more than a quarter. Hopefully it'll be less than half, right? But obviously we've all been living in a higher, well, and I like to say this because people say high interest rate environment. I say higher interest rate environment. I remember when I was growing up, my parents had mortgages in the teens, right? They were 14, 17, whatever. So, obviously, interest rates were so held artificially low for so long, and then they went up so quickly that it was a shock to the system. But they're not at historic highs, even at the high it's at. But in any case, in a higher interest rate environment, obviously that certainly affects, real estate. How has that affected you? How have other economic factors affected you? And with this, hopefully, interest rate drop on the horizon and what you see coming, what do you see the opportunities of what will hopefully be a better environment?
Yeah, and it's a great question. I mean, at the end of the day, I think the simple way to answer that question is how it's affected us. I mean, we actually had our biggest year last year as far as buying new opportunities. And at the end of the day, the fundamentals haven't changed. Like our fundamentals of our underwriting hasn't changed. I mean, surely we've looked at way more deals in order to get ones that actually kind of fit within the box. But the fundamentals haven't changed. If we can't make it pencil out, or if we can't get comfortable with modeling things even just 4 months ago, we weren't modeling for any type of reduction anytime in the next 2 years. And so that wasn't in our model, wasn't baked in. In fact, we're not even baking it yet because I still don't believe it until I see it, right? At the end of last year, I will say that only one time in history has it ever worked in our favor. We had the deal we closed last December when, the market, I forget when, the different Fed meetings, but there was a period where he had suggested that we were going to see a cut and it never happened. And so I think but from the time we had that deal signed up to the time we actually closed, it actually went down by about 45 basis points our term. And so it worked in our favor in a big way, and it was a fairly substantial deal. However, outside of that one, it's just if we can't make economic sense of it today, we don't do the deal. But I'll say on top of that, I think there's other opportunity. It's not just what's the value today? It's really understanding how to do a discounted cash flow and figure out what the real intrinsic value is of a property and really getting comfortable with in the long term, does this property, while it might not, just quickly 1 year underwriting, it might not fit the buy box, but what does it look like if this is truly a legacy property, you intend to hold it for 7 to 10 years? Does the intrinsic value of that, future intrinsic value of that, does that truly justify the acquisition? We got a deal right now, which is absolutely phenomenal. It's never traded hands. It's still owned by the original developer in Ann Arbor, Michigan, phenomenal market, one of the most affluent markets in Michigan. And, the rents are 40% below market. And so while the going in cap rate is really low, literally we're 40% below market rents, and we're not going to get up there right away, but we will over 5 and 6 years. And the overall intrinsic value of that asset is astronomical. It's huge. And so, but just back to the point of our fundamentals haven't changed, And so I think that's why last year we had such a good run. We, in late 2020 when rates started going down, and in 2021, 2022, we were actually more net sellers, and we don't really view ourselves as sellers. We're not just get in, fix it up, and flip it, but when you have the opportunity to exit out of something, and, I didn't know if it was the peak or not, but what I did know is that something that we've owned for a number of years, we've extracted what we feel is as much value as what we possibly can out of it. And then the unsolicited offers we're getting are, multiple X's higher than what we think the value is. Well, now's the time to sell. Let's go ahead and prune out the portfolio. And so we actually didn't buy a ton during those years, but it put us in a phenomenal position last year to take advantage of everyone else being on the sidelines. Because what I feel is anyone that's selling, anything that's come to market last year, or even right now as we're having this conversation, there's a motivation to sell. Because if you don't have to sell, you're not selling right now.
Right.
Whatever that motivation might be, it is not the ideal time to sell, especially with the announcement that rates might be coming down a little bit. If you're coming to market with something today, there's something that's encouraging, for you to divest of that asset. So again, I think just having the possibility to have the capital and have the track record and have the trust from our investor base, has really allowed us to take advantage of now this downtime here that we're going through. And I think that as rates go down, as more capital start coming off the sidelines, and it'll become more competitive, right? And so we're trying to back up the Brinks truck now and buy as much as possible that fits our buy box. Because again, if it's coming to market, there's a reason. There's still people buying, but it's not near as much competition as what we saw, 2.5 years ago. It's a 9-day difference. So we see it as a real buying opportunity. Again, you can't time the market, but you can see the activity of like, a Blackstone and KKR. There's lots of recent news. I mean, they're going kind of all in now. They're saying that we've already reached the bottom or we're near the bottom. I mean, you can't time it, but as long as you get within a year or two on either side of that equation, if you truly, you'll still do pretty well in the long run, especially if rates start coming down over the next couple of years. I think we'll all be happy that we bought stuff in 2024 and 2025.
Love it. Love it. So my second to last question on the podcast is always just give people an opportunity to talk about where to find out more about them. But, with you, can you also include, talk to us about the other things you have going on the podcast about, all that kind of stuff. Give us a little more on that stuff. And then what people can find out more generally about.
Sure. So the podcast, Real Estate Investing for Cash Flow, I've been doing it now for over 10 years. I mean, it's a commercial real estate show where I interview, smart individuals like yourself and other folks that are in the commercial real estate world. And just, again, try to extract good value from the conversation, learn life lessons that they've learned along the way. And hopefully we'll leave the hour show every time and a smarter individual. So that's the objective of that show. And then the book, the book is a compilation of, it's equal amounts of the really smart folks I've interviewed over the past 10 years that I've, taken their knowledge and integrated it into our own business, as well as my own life experiences of building a portfolio, going through the crash, rebuilding, what asset classes I like and why. And it's just kind of a compilation of those two things. But really based on the premise of buying assets that cash flow, that have the ability to actually cash flow, not just leveraging the appreciation that may or might not come, but just, truly buying things that can sustain themselves both today as well as in the long run. So you can actually get a free copy of the book. I'd be more than happy to share the link for your listeners. It's kevinbupp.com/free book. And I think all you have to pay is like $6.99 shipping and handling. You get a physical copy of it. And then as far as learning more about us and the company and the different offerings that we have, investwithsunrise.com is our website. And you can find information about our current offering, which is SEI Growth and Income Fund 4. We even go as far as we're pretty transparent with stuff. I mean, you can access, if you obviously put your email in and create a profile, you can access, we offer up appraisals on the existing deals that are in that fund. We offer up a general synopsis of the business plan, phase 1 reports, surveys, like all the third-party reports in addition to appraisals we offer in there. And then we kind of give an overview of what the business plan is for the respective property. And we do the same thing with older stuff as well that we still have in older historic funds. And so if anything else, it's a good educational resource, just to kind of learn, again, what it is we do, how we do it, why we do it, and hopefully you can take away some gold nuggets from it as well.
Excellent. And all those links will be in the show notes, folks, if you're driving or whatever. My final question on the podcast, Kevin, is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world, from people from oppression to why I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you, and how does it impact your life and business?
Yeah, it's a great question. I think just having the flexibility to kind of make each day on my own, make the decision of what that day looks like. But more specifically for me, I've got a young family. I've got a 7 and 10-year-old. And I know that time's finite, and I know that, and none of us are guaranteed tomorrow. So I think, having the flexibility and freedom to actually spend as much time on this waking earth as absolutely possible and create as many memories as possible. So, I mean, that's, if I had to really hone it into one thing, that's it for me.
Love it. Kevin Bupp, thanks for being such a great guest on the DealQuest Podcast.
Corey, thanks for having me.